And yes, we just had a nasty stumble. The technicals right now on gold argue to me that right now, I want to see some numbers above us right now. 25 to 45, 50 zone. We're trading 44.20 right now as we speak.
Yeah, yeah.
I think you saw the low already. I think that low at 4,100 was the sweeper. It's got to be the top, right?
Yeah,
Okay.
a minimum
Minimum.
high of
Yeah. Yeah.
$8,000 or
Yeah.
something like that, and
Yeah.
maybe upwards to 500 in silver.
I think the crisis we're facing in major markets, hence the economy, hence the everyday guy, will spark that remonetization of gold.
Right.
It'll first pop up there, as you said, overseas, like China maybe. Stock market pricing, the government bonds go through crisis. All kinds of concepts get tossed out the window as, oops, it didn't work. And then
Hmm.
finally, gold ascends.
Yes.
The Fed will acknowledge it. ECB will acknowledge it. BOJ has already acknowledged it. They
Mm.
print during all the big bear markets in the stock market, and it doesn't save them. Once those bubbles break, they break. It goes into gold. And gold knows that. Gold is nothing but the inverse of decaying money units.
Hmm.
Okay, they print, print, print. Gold goes up, up, up. It
Yeah.
maintains its value versus
Yep.
the so-called money. Okay,
Hmm.
um, and it's not just what the dollar is, or it's a combination, of all the major currencies in the world. Well, we're headed for that crisis. Gold knew it a long time ago. It's now powered into a more accelerated phase. And yes, we just had a nasty stumble.
Yeah.
It's got to be the top, right?
Yeah.
Okay, well, yeah. No. Our technicals say no. Look for a buying point if you're not in. MSA put out three major long-term based buy signals starting in March of 24,
Hmm.
June of 25, and the November close of last year
Hmm.
for both gold and silver. We're not going to offer any more primary entry points. If you're
Hmm.
not in, you're chasing. And that's fine if
Yeah.
you want to participate. But got to remember that when you buy well after those buy points, and that average for silver, for example, those three buy points was
Yes.
30, our average price was 36 bucks.
Yeah.
Okay. Yeah, you've given back some profits, but where do you sit?
Hmm.
Yeah, right now even. Double. Okay. Uh, we think by technical assessment that this pullback that we had at the end of January, and if you look at your daily charts, it was like a one-day crash followed by follow through on the first day of February. You could draw a line sideways on silver and gold through that price level.
Hmm.
Most of the action since then has been above it.
Hmm.
We got below it this week. Why? Okay, think about this. For 15 months in a row, and even more months on a closing basis and a high basis,
Hmm.
gold has continued to make higher highs,
Mm.
higher price highs
8
during the
months in a
higher
row.
closes.
What looks like a breakdown is actually a stress test of a much bigger trend. As Michael Oliver points out here, gold's rise isn't about hype. It's tracking global currency debasement across all major economies, not just the dollar. A 15-month streak of higher highs and closes is statistically rare, and short-term drops like late January often shake out late entrants, not long-term trends. The real risk isn't missing the top, it's buying late into a structurally strong move and mismanaging volatility. Next, Michael Oliver discusses why the first monthly weakness may not mean what investors think.
Finally, February produced a down monthly close in
Uh-huh.
gold, okay, and produced a lower price high. The one thing we haven't done, and we noted this in our weekend report, when gold was still above the February low then, we said, hey, if we'll just drop and take out 44.23, it was the February low, gold will finally, after 15 straight months of higher lows, will, oops, made a lower low.
Uh-huh.
And it did. And right now we're back up to that low 44, low 4400s.
Yeah.
Uh, we think that on a short-term basis, signals that say that we're going back up again are literally about 2.5% above where gold is right now. You get back up there, especially on a weekly close, like in the lower to mid 4500s, and assume, okay, that was it.
Uh-huh.
So if you're not long and you're a chaser, well, at least view this as an opportunity to enter after a good break.
Mm-hmm. Well, I saw that Matthew Peipenberg, he said that this is gold's biggest fire sale in 43 years, he suggests. So that even if you haven't gotten in at those recommended entry points that you outlined to your
Yeah.
subscribers, there's certainly time yet. I think you would agree. And I seem to recall you were looking at some sort of an ultimate, well, at least a minimum
Minimal.
high of
Yeah. Yeah.
$8,000 or
Yeah.
something like
Yeah.
that, and
Yeah.
maybe upwards to 500 in silver. I mean, there's who knows how high is the sky, right? Because
Yeah.
we don't have any other structures to look at essentially. So it's
A single red monthly candle is suddenly being sold as a trend reversal, but that's where the narrative breaks down. As Michael Oliver points out here, breaking a 15-month streak of higher lows matters, but context matters more. Price is already reclaiming that level within days. A 2.5% move above current levels could invalidate the entire bearish shift, showing how fragile sentiment-driven reactions are. Wall Street often amplifies tops, right when structural momentum remains intact, especially during liquidity transitions. Next, Michael Oliver unravels the bigger question of how high gold can go without historical limits.
it would appear to be blue sky above, but at some point there. Here's the question I have for you, Michael. So you have this time it is different.
Hmm.
As you point out, who's going to bail out the Fed this time? Who's there is big enough to bail out the whole world essentially?
Hmm.
So now we get to the action of gold and this sort of seemingly exponential rise in the price of gold and silver. Are we at the point now where we are going to have some sort of a re remonetization of gold, possibly? Do
Hmm.
you see
Yeah,
that
I
as
think
a,
so.
I
Yeah.
know Alistair believes that's, and
Yeah.
increasingly, a few years ago, you'd think that most people would say, nah, that could never happen.
Yeah. Yeah.
But now
Right.
you're seeing it happen, and the BRICS, of course, have been preparing for this. They've realized that the West has cancer and it's going to die.
Hmm.
And
Hmm.
so it's just sort of in a way, I think, playing, while we're engaged in
Hmm.
extremely expensive hot wars, the West is sitting, the East is sitting, the BRICS are sitting back there saying, aha, let them go, let them go, let them go, and let them self-destruct, much as Russia did, the Soviet Union did in its own way. Maybe they learned some lessons that we haven't learned yet, but are about to.
The real question isn't gold's price, it's whether the entire system behind it is breaking. As Michael Oliver points out here, and when markets start asking who can bail out the Fed itself, you're no longer in a normal cycle. You're in systemic risk territory. The idea of gold remonetization once sounded extreme, but central bank buying trends since 2022 suggest a quiet shift already underway. While media focuses on rate cuts and inflation prints, the deeper story is global trust erosion in fiat systems. Next, Michael Oliver discusses how this potential reset could unfold through crisis.
Yeah, I think the crisis we're facing in major markets, hence the economy, hence the everyday guy, will spark that remonetization of gold.
Right.
It'll first pop up there, as you said, overseas, like China maybe, and then it'll spread. But it'll require that we go through a lot of pain
Mm-hmm.
before people finally throw their hands up in the air and say, "God, it hasn't worked. Let's go back to this." My granddad told me so.
Yeah.
He,
Yeah.
he gave me a gold coin. Okay. Anyway, yeah, I think that'll happen, but it won't happen in an incremental, uh, soft way.
Yeah.
It's going to require the regurgitation of error.
Yeah.
And that means stock market pricing, government bonds go through crisis. Uh, all kinds of concepts get tossed out the window as, oops, it didn't work. And then
Mm-hmm.
finally, gold ascends. It'll already have ascended in price, but at that point become institutionalized again. But
Mm-hmm.
it's going to take that crisis. And I think the crisis is right at hand.
Mm-hmm.
I'm seeing it in too many major stock markets where they have been, while they've been going higher than, let's say, 2024 by small double-digit amounts. This is similar stuff happened in 2000. We
Mm-hmm.
called the top in January of 2000. In August, they made new highs again.
Markets rarely reset gently. They break confidence first, then rebuild trust later. As Michael Oliver points out here, any return to gold as a monetary anchor won't come through policy choice but through failure, likely starting in bond markets before spreading to equities. The comparison to 2000 is critical. Markets peaked in January, made new highs months later, then collapsed, giving investors false confidence in the process. Today's small double-digit gains mask underlying fragility in credit and valuations. Next, Michael Oliver shows how this slow topping process misleads investors before major shifts.
Like 10 or 15% above where we said sell it. But we said it would be a topping process. That's the way the stock market ends, in a way that is comfortable. It doesn't crash out of the door usually.
Yeah,
That might happen later. It doesn't always happen even. You don't always get crashes in the bear markets. 2000, 2002, there was
sure.
never really what you could call a crash. But anyway, I think that's where we are on that category. And that category, when it does break, of course, all those data points
Hmm.
that people like to point to, and plus the credit crisis that we're now entering, that finally they're
Yes,
acknowledging. Okay, MSA warned months ago, something's going on here, guys.
yes.
The Fed will acknowledge it. ECB will acknowledge it. BOJ has already acknowledged it and go berserk, in which case uh, it won't work, but it will create money, and that money will go somewhere, but it
Hmm.
won't go to the broken categories anymore. It never does.
Hmm.
They
Hmm.
print during all the big bear markets in the stock market, and it doesn't save them. Once those bubbles break, they break. It goes into gold.
So Michael, you believe that we're probably reaching a bottom, a basing point here in gold and then maybe silver as well.
Yeah,
It seems to me that, remembering 2008, 2009, when the margin clerk calls, you got to sell what you're able to sell, not
yeah,
necessarily what you want to sell.
The biggest market danger is how normal the top feels while it's forming. As Michael Oliver points out here, major tops aren't explosive. They're gradual, comfortable, even convincing, often extending 10 to 15% beyond logical exit points. Central banks may respond with liquidity, but history from 2000 and 2008 shows printing money doesn't save broken asset classes. It redirects capital. When credit stress emerges, forced selling begins, and investors liquidate what they can, not what they want. That's when leadership shifts quietly. Next, Michael Oliver discusses how liquidity stress starts showing up beneath the surface.
And I'm wondering, we see private equities had some
yeah.
issues, BlackRock closing the door, a
Mhm.
bunch of these other big guys not allowing people to take out their money, and you just wonder if there might not be some some liquidity
Yeah,
issues that are
yeah,
starting to rise up. And so, yeah, what can you sell? There's always a bid for gold. There's always a bid for silver. So
yeah,
that would be one place that, especially people that don't really understand that gold is money,
yeah.
and it's maybe just a trade, that maybe that accounted for some of the weakness that we've just seen.
Could
And
be, could
yeah,
be. I know there's a lot of leverage. We all know that in the stock
yeah,
market. It's never before been this high.
yeah,
But on the other hand, we did a detailed archival analysis of the
yes,
2008 break.
uh-huh,
And that was very similar to what we're getting right now in many ways, not just looking at the price chart, but via our momentum metrics. And frankly, by our work, this week in gold is comparable to the final down week that occurred in October of 2008. And if
oh,
you'll recall what happened then, fundamentally, Bernanke and his dummies had been doubting the mortgage problem would be a
yeah,
problem.
Liquidity doesn't disappear loudly. It locks quietly behind closed doors before markets react. As Michael Oliver points out here, when major firms restrict withdrawals and leverage sites at record highs, the system is already under stress, even if headlines stay calm. The comparison to October 2008 is critical, because gold initially dropped during forced liquidation, not because fundamentals failed, but because investors needed cash. That's the part rarely explained. Gold can fall right before it surges. For portfolios, this means volatility may signal transition, not breakdown. Next, Michael Oliver discusses how denial at the top mirrors past crises.
uh-huh.
He repeatedly said it's not going to be a problem. It's under
Oh,
control. Okay.
just
Well,
localized. It's
yeah,
just localized. It's
yeah,
not going to go
yeah.
national. Yeah.
No, it's the guys in The Big Short, you've seen the movie, the
Yeah,
various
sure.
guys,
Yeah.
they were laughed at by all their peers.
Hmm.
They showed it in the movie even. You know, they were right. Bernanke was wrong. And after the October 2008 stock market collapse, which finally occurred a full year after its high, whereas it
Uh-huh.
had been going down for a whole year, and gold suddenly in late August, late September, early October, gold was still, and early no October of 2008 was still rallying back up almost to its high, which had
Uh-huh.
been just over 1,000 at that point. Okay.
Uh-huh.
And it then collapsed. Okay. It was all done in 4 weeks of October.
Yeah.
Then what happened fundamentally is very interesting. Not that this has to happen, but the conditions are ripe. You had some major bank failures in
Hmm.
that August, September, October period in the
Yeah.
stock market. The Fed finally woke up and they took the page out of the Japanese book.
Hmm.
Let's do QEs. And they started QE when? November 2008, right after that October collapse. They said, okay, QE time.
Yep.
And what did the stock market do? It said, oh boy, tried to rally, really didn't. Continued on down till March, another 30% drop
Wow.
where
Yes.
it closed October. What happened to gold during that same period?
Started
Back to
ticking
its
up.
high almost immediately,
Right.
and onward,
Every,
upward for years. So
yeah.
a total divorce, and the Fed panicked. Well, what's going on right now? Now you've got a credit crisis that's starting to be acknowledged finally. It's
Yeah.
impacting the big banks and the credit card companies. Two, you got a government US bond in panic mode, far bigger than the mortgage problem. Now, if Powell's going to sit on his hands till he leaves in May, he's going to go out in history as having played a political game, wouldn't cut because he didn't want to help Trump,
Yeah.
the war with Trump. And he'll be blamed. Trump will turn around and say, see, look what this guy caused. Okay. So Powell's got a choice now. You got a month and a half, guy. What are you going to do? You want to finally cut some rates so you don't go down in history as a, politico?
The most dangerous phase of any crisis is when leaders insist everything is contained. As Michael Oliver points out here, the 2008 playbook shows denial persists until failure becomes undeniable, often after markets have already declined for months. Gold's sharp drop in October 2008, followed by a multi-year rally, reveals a key pattern. Policy response lags reality, then overcorrects with liquidity. Today, rising stress in banks, credit cards, and bonds suggest a broader issue than what's publicly acknowledged. Investors should watch actions, not words. Next, Michael Oliver unravels how policy panic may unfold from here.
Uh, anyway, I can see panic mode because you got to watch the T-bonds. They don't come out of this hole, and I don't think they're going to this time. They've been
I don't
too
think
much
so.
stuff.
No.
And the other credit crisis, the one that credit cards and all kinds of credit default situations that are going on, and you could see it in the bank stocks and in XLF, the ETF of the financial sector.
Hmm.
Uh, those are too big for the central bank to ignore.
Yeah.
In which case Berserko starts, and it's almost like an overlay of 2008. Uh, anyway, we shall see. But the technicals right now on gold argue to me that right now I want to see some numbers above us right now
Hmm.
reached. And
Hmm.
specifically, it's up in the low 45.25 to 45.50 zone. Okay.
Yeah.
We're trading 44.20 right now as we speak.
Yeah. Yeah.
Okay. You get a day or weekly close up there, especially, and that's it. I think you saw the low. I think you saw the low already. I think that low at 4,100 was the sweeper.
Hmm.
It took out the Feb low finally after 15 months of incredible rise.
Hmm.
Lows getting higher every single month. You took out a prior month's low, and everybody said, "Oh, it's the end of the world." I
Yeah.
mean, can't it have a down month finally?
Yeah.
Okay.
Yeah.
Anyway, I think that's where we are.
So we've seen the lows probably. And last time I had you on, you said you're quite confident that that $50 silver, which was the ceiling,
We're not going to use it as
it's not going
support.
to break through that.
No, I'm not going to go back there, I don't think
No, it's
either.
not even back to it. I
No,
don't
no.
think.
I think you saw what you saw this week. And if we get a few, not much upticks, I'm going to say, yeah, that was it. And then the issue is how fast do you go up and take out the highs, and I think that could be fairly quick, like, within April or something.
Markets often label a normal reset as a collapse right before momentum resumes. As Michael Oliver points out here, breaking a 15-month pattern of higher lows triggered panic, but reclaiming key levels around 4,525 to 4,550 could quickly flip sentiment back to bullish. The overlooked signal is stress in bonds and financial stocks. When those crack, central banks typically respond with aggressive liquidity. That's when gold's next leg often accelerates, not before. Investors focusing only on price miss the underlying shift in risk flows. Next, Michael Oliver discusses how quickly this rebound phase could unfold.
So you expect at some point there's going to be a significant equity market puke
Yeah,
that would drive huge amounts of money into the precious metals and maybe a lot of the other commodities too, to the extent the
yeah,
economy is
mhm.
vibrant. I mean, if the economy is alive, I mean, we could go into some sort of a hyperinflationary depression, which would be the
Sure,
worst of
yeah.
all worlds, I think. And that's what I hope. I pray to God that doesn't happen. But it seems to me that that's a possibility given the bond markets, given the situation these politicians find themselves in. What are they going to do? They can't be seen to let the
Mhm.
market work its way out. I mean, we saw 2008, 2009. It's interesting. At that time, I remember talking to a lot of pretty senior financial guys, and the only one I interviewed on my radio show was Jimmy Rogers, who thought they should have just let the thing go. They should have just paid the price, paid the piper, and let's get on with the free market.
Clean house. Yeah, let the market clean
Let the
itself
market
out. Yeah.
work. But the
Mhm.
politicians and of course the ignorance of the public won't allow politicians to do that in a democracy.
The real risk isn't a crash. It's what policymakers do to avoid one. As Michael Oliver points out here, a forced equity sell-off could redirect massive capital into commodities. But political pressure makes true market resets unlikely. Instead of letting markets clear like in 2008 debates, intervention often leads to prolonged distortions, raising the risk of stagflation or even hyperinflation scenarios. That creates a difficult environment where both stocks and bonds struggle simultaneously. For investors, this isn't about timing a crash, but preparing for policy-driven volatility. Next, Michael Oliver talks about where capital actually flows in that environment.
So anyway, Peipenberg thinks that this is the best. This is a fire sale, the best in 43 years, and he may very well be right.
Price-wise, it is, but actually percent-wise, it's not that serious
Yeah.
going
Okay.
back that many years. But yeah, price dollar-wise, it's a big,
Dollar
big,
wise, yeah.
yeah, yeah,
Well, point well taken.
yeah.
So, how the gold and silver mining shares faring compared to the bullion, to
I
the
still
metals?
favor them over the next year or so. I think that the miners will be the place to be. Got to remember, let's say you're an average investor or you're a portfolio manager. You're
Hmm.
not a gold bug. Okay, so you've missed the move so far.
Yeah.
Okay, but the old rule that I think Morgan Stanley said, no, it goes out the window. 60-40 rule. Percent
Yeah.
stocks, 40% bonds. Okay. Well, they said, no, that's not right anymore. It should be 60-20, 20-20. 20% gold, 20% bonds. Well, even that isn't right. But right now, if you look out there and say, well, I'm gonna go into the other alternative. Stock market looks questionable to me. Maybe it's
Yeah.
risky. I'm going to move some money to T-bonds. Well, that's not the place to have been for the
No,
last
no
several
more.
years, and it's
No.
worse than
No.
right now.
Yeah.
Okay, so it's vastly underperformed stocks. It's continuing to break structure on our momentum, saying, hey, another leg down could occur, up in yields, that is. Gold's the only place, the monetary metal is the only place that's beaten the hell out of the stock market. And even with this break, if you measure from where we are now back a
Yeah.
year ago, is beating the heck out of everything, even
Everything.
with the break. Yeah.
That's
So
correct.
from an investment grade point of view, not a
Hmm.
trader,
Hmm.
uh, they've got very few places to put their money if they want to move it.
Yeah.
The old orthodoxy doesn't work.
The traditional 60-40 portfolio is quietly failing, even as most investors still rely on it. As Michael Oliver points out here, bonds have underperformed for years, breaking the assumption they provide safety during equity weakness. That leaves investors with fewer viable options, especially when gold has outperformed both stocks and bonds over the past year despite recent volatility. The shift isn't just about returns, it's about structural change in capital allocation models that institutions haven't fully adapted to yet. This forces uncomfortable decisions about diversification,